What's going on, everyone? Welcome to this video. First off, I want to personally thank you for being here and becoming a part of this community and this journey. By joining this space, you've made a decision to take your trading more seriously, and my only goal here is to help guide you with structure, clarity, and consistency. My name is Samaje, and inside this video, I'm going to show you exactly how I view the markets using what I call the institutional flow model, okay? This isn't about guessing, it's not about chasing trades, and it's definitely not about gambling. It's about understanding how price moves, why it moves, and how institutions leave footprints that we can learn to recognize. When I look at the markets, I'm not just looking at candles, right? I'm looking at flow. I'm looking at where liquidity sits, where inefficiencies exist, and how price moves between key areas based on institutional behavior. The institutional flow model is built around understanding market structure, liquidity, imbalances and inefficiencies, timing, and high probability execution zones. Everything we do inside of this video will revolve around those core ideas. Inside the inner circle, you're going to get access to market breakdowns, trade ideas and execution examples, educational content, strategy explanations, psychology and risk management insights, and real-time perspectives on how I'm reading the markets. But more importantly, you're going to learn how to think, not just what to trade. I also want this to be a focused environment. So I would love for you to ask questions, stay engaged, review the material, and most importantly, be patient with your growth. Trading is a skill, and like any skill, it takes time, repetition, and discipline. My goal inside this video and my whole entire inner circle is simple: to help you build confidence, develop structure, and learn how to read the markets through the lens of institutional flow. So again, welcome to this video. Welcome to the inner circle. Let's get to work. The institutional flow model is built on the idea that price moves with purpose. It seeks liquidity, creates imbalances, and follows structure. Once you understand where liquidity is and how institutions move, the market becomes less random and more predictable. Okay. So this is the institutional flow model logic, right? Bias, right? Liquidity, manipulation, SMT confirmation, expansion. That is where standard deviation come from, also known as STDV, right? We use SMT correlation from NQ and ES, and then we're able to use our standard deviation tool to project the ranges in which we see liquidity lying, which is our recent highs and lows, session highs and lows. So what we're going to do now is, before we get into all the charts and stuff like that, we need to cover some basic knowledge first. So it's going to be a little bit boring at the beginning, but we're going to get into the good stuff. Before we get further into liquidity and standard deviation projections and things like that, we need to understand how price moves. Okay, again, the market is not chaotic, it is engineered movement. Now, the truth about price is that honestly, it doesn't move randomly. Okay, price moves to facilitate orders, seek liquidity, and deliver price efficiently. It's not chaotic. It is engineered movement that goes from buy side liquidity to sell side liquidity. And here in this image, you see where we've built sell side liquidity. After sell side liquidity is taken at the lows, then there's where buy side liquidity is taken to continue to, again, just generate the liquidity that needs to be placed in the markets. Now, there is a price delivery cycle that we pay attention to, right, which is called AMD: accumulation, manipulation, and expansion. This is not a theory. This is how large players operate in the market. During that accumulation phase, we think of it as position building, order stacking, and preparing for movement, preparing for that next stage, right? Smart money builds quietly before moving price, okay? Some beginners see this consolidation and think nothing has happened, but in all reality, something bigger is actually being prepared again for that next move. In the manipulation phase, it's not random volatility. Okay. In the manipulation phase, we are moving price into liquidity, triggering stop losses, and trapping early traders. So the purpose of manipulation is to create the fuel needed for expansion. That way, again, we can move forward to the next phase. In that next phase that we talk about is distribution, also known as expansion. Okay. Expansion is where price moves aggressively, follows through directionally, and delivers the intended move. During this phase, trend forms, momentum builds, and profit opportunities exist all here. In forms of speaking about reversals, they happen when liquidity is taken, right? That is how we're able to even get our entry. Positions get filled, the market shifts direction after clearing orders, and then boom, we get our reversal. So the most important key insight that we want to take from reversals is that price must take liquidity before it can move efficiently, and it happens over and over in the markets. Now let's dive a little bit deeper into delivery legs, and this just goes back to why I say that price doesn't just move randomly, okay? It moves in legs. You have an impulse, again, which is our strong move. You have a pullback, which is a retracement, and you either have that continuation or reversal, right? So in hindsight, every move is part of a larger delivery cycle. If we look to the right hand side, this is kind of like a diagram showing you just a little bit of how price moves. So you have consolidation, right? You have that expansion, then you have that trend, right? And when we think of trend, we think of an uptrend or downtrend. So in this case, we have a uptrend. We're creating a series of higher highs and higher lows. Price comes to a old high, a fair value gap, a volume imbalance, or order block, and that is where we catch our reversal, right? Because that was a draw on liquidity. And then boom, we have our market structure shift or change in state of delivery, and price continues. So this is kind of just a breakdown of how price moves in delivery legs. Talk a little bit about imbalance versus balance. There are only two real states in the market. Our balance, which is our accumulation that we talk about, that's that sideways movement, equal buying and selling, and position building. On the other hand, our imbalance is that expansion, okay? That is strong directional movement. One side is in control, whether it's buyers or sellers, and we're creating inefficiency in price during that expansion phase, which are also liquidity targets and pools that price comes back to later in the market. Okay, so key insight. Price moves from balance, imbalance, balance over and over and over. Inefficiencies, okay? When price moves aggressively, it leaves behind inefficiency, unfilled orders, gaps, and price delivery. I know you guys probably heard of fair value gaps and volume imbalances. This is kind of what we're talking about when we're talking about inefficiencies. Okay. Price often pulls back to these after making strong moves. And if inefficiency is not just a gap, it's evidence of aggressive institutional order flow. The more confluence around it, the more likely price is to rebalance before continuing. Markets seek efficiency over time. Two of the main inefficiencies in the market that we use are fair value gaps and volume imbalances. So here in this image, I have where we took buy side liquidity. Even before we took buy side liquidity, there's this 1 hour imbalance that we're talking about. Okay. When we think of an imbalance, right, we think of price. In this case, price put in a strong side of buyers, which left behind a gap between that candle closure and that next candle open. That is the imbalance that we're talking about. Then we come and take buy side liquidity, right? We put in this 1 hour fair value gap, which is also an inefficiency. And I want you to see how price likes to come back to the inefficiency, right? And it likes to put candle through those because that's where liquidity is lying. And what do? We get a market structure shift, okay? Kind of previously what we talked about on a couple slides earlier, our CISD, and price continues in the way that it needs to go. All right, so there is one more thing that we need to kind of cover bases with about time frame fractals before we move on, and head out of how price moves. Okay, time frame fractal. Okay, the market is not trying to trick you or move randomly or base everything on indicators. The market is simply delivering price, seeking liquidity, and operating in cycles. When I say that price is fractal, it means that it's repeating itself on every time frame. Okay, so the same cycles happens on 1 minute, 5 minute, 15 minute, hour, whichever time frame. The same thing is happening, right? If we're looking at the 1 hour candle, that 1 hour candle is big. Okay, if we drop down to the 1 minute, it's showing literally 60 candles, right? It's showing 60 candles that'll make up that whole hour. You're going to see everything within that same time frame. Liquidity is exactly what allows us as traders to enter and exit positions. So let's go ahead and talk about liquidity and intent. Liquidity is basically orders in the market. This includes stop losses, breakout entries, and pending orders. Okay, it allows us as large traders again to enter and exit positions. Liquidity exists at equal highs, equal lows, previous highs and lows, and something further where we'll talk about previous power of threes, basically previous projections of the standard deviation, and also obvious support and resistance. The more obvious the level, the more liquidity it holds. Price is drawn to liquidity because, of course, orders need to be filled and large positions require counterparties. Okay, so without liquidity, price can't move efficiently the way it needs to move. Stop hunts, right? Stop hunts are not manipulation for no reason. They are liquidity collection events and necessary for order execution, right? And this is kind of how it happens. Price moves into stops, it triggers them, and then it moves in the true direction. That's kind of where we see accumulation, manipulation, and distribution. Price moves with intent to capture liquidity, fill orders, and continue direction. All right. So our only job in the market is to understand what the market is doing and why it's doing what it's doing. Okay. All right. So we're moving on along. So far, we have covered how price moves, why it moves. We've covered liquidity and the intent of liquidity, why liquidity is so important. So now that we have those basics in that understanding, we're gonna go ahead and dive deeper into the institutional flow model overview and trade flow. Right. So we're starting to talk about standard deviation projection. So standard deviation is used to measure price expansion, expected movement, and range projection. Here to the right in this picture, I'm giving you my very settings for the standard deviation tool that I use. Okay, standard deviation helps to identify where price is likely to move. On the standard deviation, we pay attention to two key areas: our negative 2.5 and negative 2.5, and also the negative 3.5 and the negative 4. Okay, those are our two key areas. Now, within the negative 2 and the negative 2.5, that is where we see reaccumulation happen for the redistribution in the same direction, or we see a reversal in this area. Negative 3.5 and negative 4 is where we see the range typically cap or end, and from there, we're looking to close our positions and let the new swing form. So this is standard deviation. So here in this picture, I am basically showing you where to spot and be able to draw your standard deviation tool out, right? So if we're looking to the left-hand side, right, we have our 1, 0.5, and the 0, and then the rest of our ranges, okay? Negative 1, negative 1.5, 2, 2.5, 3.5, and negative 4, okay? Now, when drawing out that standard deviation tool, we're only placing that standard deviation tool on the manipulation leg or the first distribution leg, okay? I want you to see closely how at negative 2 and negative 2.5, that is kind of where we reaccumulate. We take some type of form of liquidity to push us down, or we catch a reversal. In this case, to the left-hand side, we reaccumulated and we continued that move to the cap of the range at negative 3.5 and negative 4. All right, if we look to the right hand side, which is the buy model, I want to go back a little bit. Go back a little bit, okay? This left hand side is the sell model, right? This right hand side is the buy model. If you see on this buy model, right, that is that manipulation leg that we placed the fib on, right? At negative 2, negative 2.5, we reaccumulated, and then we finished the cap of the range at negative 3.5 and negative 4, okay? Guys, this is not something that you're going to be able to understand right now. You're not going to be able to go in your charts and fully understand it and be able to see everything. This is going to take repetition, it's going to take time, and it's going to take consistency. But hey, I'm here to help, okay? Now, a few things that I want to cover on where we exactly place it, okay? On a sell side, okay, if we're projecting price to go to sell side, we are placing our standard deviation at the top of that manipulation to the bottom, okay? Because we're trying to see the range of where price is going to go to the downside. On the other hand, for the buy side, okay, we are placing our standard deviation at the bottom of that manipulation leg or first distribution leg to the top of it, okay? Because we are projecting what? The upside of that whole entire move. SMT is short for smart money technique divergence. SMT occurs when two correlated markets diverge, okay? One makes a high while the other fails, and in other cases, one makes a low while the other fails, okay? So it signals weakness or strength to the opposing side. Price will not expand until SMT is present and shows manipulation leg very clearly. So In some cases, if we are bullish, we want to see SMT at the lows to support the idea of a bottom to start a buy model. In other words, if we are bearish, we want to see a SMT at the highs to support the idea of a top to start a sell model. If we see NQ make a lower low where ES fails to, that's our SMT divergence between the correlating assets. And then from there, we're looking for our PDRA to enter off of. Now we're going to move a little bit forward. Here in this picture that I have, this example that I have here, I'm showing you a SMT divergence between NQ on the left-hand side and S&P 500, which is ES on the right-hand side. Okay. If you look a little closely here with NASDAQ, you're able to see where NQ took this low, but if you look to the right-hand side, ES failed to take that low. Okay. That is the correlation between these two assets. And if you see, what played out, a bullish move after that SMT was put in at the lows. So we're going to go ahead and move a little bit forward with putting standard deviation and SMT together. Okay, remember that standard deviation is the projection and SMT is that confirmation for that projection. Together, they help confirm direction, project targets, and improve probability. We also use things as far as a breaker block or any ICT concepts as far as a higher time frame fair value gap or higher time frame order block, which helps play a big role in determining where to project off of, and as well as how we use midnight price, which is 12 a.m. Eastern time for me for our projections. Now, a lot of questions. What are we projecting? Okay. When using the IFM model, we are projecting expansion after manipulation. We are projecting liquidity targets and, of course, the standard deviation range movement. We do not guess entries. Okay. To go a little bit more in depth, we are projecting the 4-hour and the daily power of 3, which is when we speak about daily power of 3, we're speaking about accumulation, manipulation, and distribution, those 3. When we are projecting the manipulation of midnight price, we are projecting the daily power of 3. So that means we're projecting the whole daily candle movement based off midnight price, in which midnight price gives us our bias, our initial bias for the day. And when we are projecting the manipulation of the 4-hour open, we're projecting the whole 4-hour candle range. Just like if we're projecting the 1-hour open, we're projecting that whole movement, the whole movement of what happened during that whole 1-hour candle. Okay, and it's the same on any other time frame, 1 hour, 4-hour daily candle. Okay, so just keep in mind midnight price, that gives us our daily bias. We're projecting that whole daily candle. Now, not every time you will see the market complete the full model. So in that case, if we have not completed it during that 4-hour candle, you'll see the next 4-hour candle finish up that redistribution. Just as well as if we're projecting the weekly candle. If that weekly projection doesn't finish up in that whole week, and that whole week we just hit -2 standard deviation, we're expecting for that next week to finish off that last week's weekly power of 3. Okay, and I'll show you a lot of examples where it happens. SMT and breakers will also play a huge role in where we key the standard deviation tool to project the expansion move, and again we'll cover that as well. All right, so before we piece everything together and actually hop into the charts to also put everything together, let's just cover the logic and what this model actually looks for. Okay, first thing first is our bias. That is our midnight price. Every day we're waking up, we want to be able to see where midnight price is. 2 is liquidity. We want some type of drawn liquidity. We want to see our manipulation, our SMT, and of course that expansion. This is the basic flow model logic. Now let's go ahead and move forward to this next slide. And let's go ahead and break down everything that you see. This is the buy model to the sell side model. This is the whole institutional flow. Okay. As you can see down here, right, we have sell side liquidity. This is where this run starts. But before this run starts, price runs into a higher time frame PDRA, right, or our key level, whichever our key level that we choose. Okay. And we put an S and T in. Okay, so as you can see, if this is NQ, we're looking at it as if it's NQ. NQ has taken this low where maybe ES fell to, and that's kind of where we get our SMT that we're talking about. Okay, Of course, we already see where midnight price is. Okay, we see midnight price is above. We're below midnight. Okay, if we're below midnight, we always want to target back to midnight. Okay, and not all the time does market do that, but just cases here. Okay, our draw on liquidity again was this higher time frame PDRA level that we came into. We put our SMT and then we got our expansion. Okay. This was our manipulation leg. This was the first distribution leg of this move. This was our first, basically our first low, high, low, high, low. Okay. This was the first distribution leg. So we would take our fib, place it at this low, and anchor it to this high. Then that's where we see, okay, at -2, -2.5, which is our reaccumulation zone, okay, where we kind of get a jab here and we kind of come back down to grab liquidity so we can move forward. Not all the time will we continue to move after hitting -2, -2.5, okay? Sometimes we get a reversal at -2 and -2.5 as well. In this case, again, we came into -2, -2.5. We reaccumulated, came back down, grabbed liquidity of this low here to push higher. And then that's where we come into -3.5 and -4, which is our cap of the range, right? At this cap of the range, we catch a reversal, okay? Notice we still have our higher time frame draw on liquidity here at buy side liquidity, but we come short of that. This SMT is what makes us short of hitting into this higher time frame draw. That does not mean that we don't come back to it, okay? It's a higher time frame. Price is going to come to where any inefficiencies are in the market. So we put a SMT in. NQ took this high here where ES probably fell to, and then we get our first distribution leg. Okay, this is our first low, high, low, high. Okay, so this is our first distribution leg. If we're projecting the downside, we place our tool at the top of that first distribution leg, okay, or that manipulation leg, and we anchor it towards the bottom. If you notice, -2, -2.5 brings us back to midnight price. We reaccumulate, grab liquidity from this high, and then we finish the cap of the range at -3.5, -4. It happens over and over. Buy side to sell side to buy side. Okay. What do? At -3.5, -4, we reaccumulate as well. So it can be the cap of the range, but when we're looking at reaccumulation or accumulation period, we're looking at it as if positions are just building, getting ready for that next phase. Okay. We manipulate. Maybe we put an SMT in here. This is the first distribution leg of this move. Our low, our high, our low, our high. This is the first distribution leg. We anchor our standard, we place our standard deviation on this low, anchor it at this top, and look closely how -4 aligns with our higher time frame draw on liquidity, what we've been trying to reach this whole time. Okay. The only thing that kept us from reaching it the first time is we came short. We caught a reversal before then. Like I said, going back a little bit further, um, that doesn't mean we just leave this inefficiency and never come back to it. Price will come back to it. It's a higher time frame draw on liquidity. Okay. So what do? We get to -2, -2.5, reaccumulate. Okay. Notice how we jab back, but we stay above midnight price. And then boom, we finish off that move to -4, which is the cap of the range. Now I want to cover these 4 key takeaways before we move forward into chart examples, okay? Standard deviation projects movement. SMT confirms direction. We're never taking a trade with just a standard deviation, and we're never taking trade with just the SMT, okay? Without standard deviation, we're unable to project any type of movement, okay? And we're only trading expansion. We're not getting caught up in accumulation, and we're definitely not getting caught up in manipulation. When we're able to follow these 3 and see these 3, we're able to see the structure that we need to see in the market context. Okay, so always remember that structure creates consistency. All right, so let's go ahead and get into our very first example here. First thing first, before market even opens at 9:30, we're already seeing that midnight price is currently below where we are now before 9:30 even opens up. Okay, so we have a clear view that midnight price is sitting here. We've also drawn already into this 4-hour bearish order block, and we've placed the SMT where NQ has took this high that we have here, or ES failed to take this high. Not only that, we have this draw on liquidity at the equilibrium of this 4-hour order block, just as I said before. Okay, so a lot of context here. We have all this buy side liquidity here. Now, when we're talking about our projection, right? Our projection would be here because as you can see, we're already creating, it already looks like the trend is trying to create a bearish move. So from there, this leg here, right, which is that first distribution leg, this first distribution leg of this sell side model. Okay, another thing I want you to pay close attention to as well is Asia low. This is where Asia low is aligning. Okay, we want to mark out Asia low because this could be a potential target that we could hit. Okay, this could be potential where price could come to and draw to Asia low. And as you can see, it's aligning with negative 3.5, negative 4, which is the cap of that range. And we have midnight price sitting here very, very closely, not right on, but very, very closely to negative 2 standard deviation. Okay. So I'm gonna let price play out. At open, we immediately put in manipulation without taking out this SMT, right? Not only that, we have this fair value gap here. As you can see, we have this fair value gap here that we come back and retest without going further to invalidate this SMT, and then we get that move. Notice how we get that move to negative 2. We come back up and reaccumulate just a little bit, grab more liquidity, and then boom, okay, we finish off to negative 4 standard deviation, which again aligns with Asia low. Currently, of this trade, kind of like a core concept that I kind of want to point out here is institutions often move price to measured projections before redistributing. Okay, so what I'm showing here is how we moved into negative 2, negative 2.5. This is a reaction zone. Okay, price began forming structure in this area that led us to finish off the cap of this range, which is the negative 3, negative 3.5 and a negative 4. Okay, this is not random. This is institutional flow. Okay, we went from sell side, okay, drew into this 4 hour bearish order block, and then we created that model all the way down to the cap of the range. Also want you to notice accumulation inside of this zone here, so you can see clear we have accumulation, that manipulation that we put in at open, and then we have the whole distribution. Okay, so kind of what we were projecting, right, was this whole um 8 hour 1 hour candle. Okay, we basically projected the power of the 1 hour. This is the whole movement and more. Okay, so this whole 8 9 o'clock candle didn't finish this whole projection, right? So that next 10 to 11 a.m. candle finished off the whole projection. So that kind of goes back into where I'm talking about, if that 1 hour power of 3 doesn't finish up in the whole projection, we're expecting that next hour candle to open up and finish off that projection. And this is kind of what you see here in this example here. All right, so in this next example here into the charts, I want to show you how we can use past standard deviation projections to still get back into a trade or be able to get a re-entry. So notice how we kind of pull back into the -1 and -2 range, right? We placed a SMT at these highs right here where NQ failed to take this high. But ES end up taking it. Give me 1 second. Let me mark it out here. So this high here that I'm talking about. And then if we mark it out on ES, you'll be able to see it over here too. There we go. Okay, so we have this where we came to -2, -2.5 after moving. Well, even after moving down here, we came back up into midnight price. Okay, we put in this SMT here. We inversed this fair value gap. I want you to see clear where you can see the accumulation, this manipulation, and then you can see this distribution, right? Here we have a whole nother entire projection because again, this is our first distribution leg, right? Not only that, we also, one thing that I wanted to spot out as well is when we're placing these projections, okay, we get higher probability when they're aligning with past previous highs and lows in just sessions. Like if you see this here, you're able to see that kind of like this order block, I guess you would look at, or like a demand zone, it aligns with negative 3.5 and negative 4. Okay, this is an inefficiency. That's our PDR right here that we're seeing. All right, so if we kind of let this play out, right, like I said, this nice inverse was very, very nice to come up off of. We come to -1, we pull up just a little bit without invalidating this SMT. Okay, this SMT is still holding. All right, and then we kind of just chop around. But I still just wanted y'all to see how you still can use past standard deviations, okay, from the past to be able to still spot areas in the market that you would want price to come back to. Most importantly from this trade, all I was really just trying to get you guys to see is the accumulation that we have here, okay, this manipulation, right, and then the distribution that we had. Right, this distribution that we had almost to the -2, but not so closely there. All right, so in this example here, we have our SMT divergence, right? Our SMT divergence. NQ took this high where ES fell to. We also want to see where midnight price is, okay? So we see 930, let me see, this 930 candle was here, okay? This was our 930 candle right here. Price was just chopped, so not something that we wanted to be in this early because we didn't see a SMT. Me personally, again, I always like to see some type of SMT that kind of gives us the indication that, okay, something is about to reverse, there's about to be a change, okay? But again, always before then, we want to spot where midnight price is. So all in this point of accumulation of that position building before the next phase, we're above midnight price. Not only that, we have London lows lining down here. So let's go ahead and mark out London lows, okay? Because this is a potential target, especially if we're above midnight price. So London lows aligning here, right? Drop down to my 1 minute and we just want to look at further context, okay? Again, we see the clear accumulation. We've came back to midnight price. Midnight price has been acting like a support area where we've came to it, we bounced off of it, came to it a little bit, played around under it, and bounced right back up, okay? Something I want you to notice is this inverse fair value gap that we have here, right? Not only that, we have a CISD, a 1 minute CISD. Remember, CISD is just also known as a change in direction, okay? Change in state of delivery. So we're going to also mark out this 1 minute CISD that we have here. Okay, now our projection, right? This is the first distribution leg, right? So we would place standard deviation at the top and anchor it here at the low, right? Now let's check our alignments, right? Currently we see that -2 and -2.5 is aligning, okay, with midnight price. And we have -4 standard deviation just before London's low. Let me turn on my S&D profile so I can make sure that's where London low is. Okay, yeah, London low. So yeah, let's go ahead and play out. Let's play out this trade. Let's see how this will kind of just play out this price action. Okay, we come to -2, we pull back up here just a little bit. We're still bouncing at midnight price, and then we finally get that move into the cap of the range. Okay, we didn't all the way hit -4 at this point, if I'm not mistaken. We do. I'm gonna go to our 5 minute chart. Let's see. So we pull back up to midnight price just a little bit, right? And then that's kind of finally where we finish off that -4 standard deviation projection, right? We didn't all the way hit into London's low, but again, that could have been a potential target, okay? So SMT divergence, okay? Again, that just tells us, hey, something is about to shift, okay? That is that correlation between NQ and ES. Okay, this is our 1 minute CISD. We also have a 5 minute CISD. I'm sure if we were to go to the 15 minute, here's our 15 minute CISD. So the more context that you get on the side of which direction market structure or market context is telling you, you want to be looking for those bearish PDRAs. So if price is bearish, I'm looking for bearish CISDs. Okay, I'm looking for bullish fair value gaps to be inversed. it ran through. Okay. I'm looking for demand zones and such as these to also be ran through. Okay. So this is this trade, right? Also notice again where I talk about -2, -2.5 being our reaccumulation. Look how we come up to reaccumulate, and then we bounce right back lower to finish off that -4 standard deviation to cap on the range. And then what do? We accumulate. We're building again for the next position. All right, so at the point of this trade here, right, London has already taken out and swept Asia's high and Asia's low. At this point, we're chopping at the top. We're seeing major rejection to the upside. If you can look at, if you see the 1 hour and the 4 hour candles previously here, there's a lot of rejection at the top. Not only that, right, you can see our SMT here at these highs. I don't know if I've mentioned yet already, but SMTs on the external side of liquidity is always a higher time frame trade, always, right? When we see those trades or those SMTs that are in internal liquidity in the inside, right, we know that external is here at the bottom and external is always at the very top of a trend, right, or the market. All right, so I just wanted to point out and let you know that it is not saying that it won't happen and your trade won't play out, but it is lower probability when it's inside of internal liquidity. Okay, but anyways, moving forward, we have our SMT at the highs where NQ took the high where ES fell to. ES was kind of more of the stronger asset, and let me tell you why. Right, in any case that we have SMTs, right, and one fails to take another, but the other one does, right? The one, if we're looking at a short bias, right, the one that fails to take this high, wouldn't it be higher probability because obviously it's more rejection of the upside of that typical chart than it is the other one? Like in this case, not saying that NQ wasn't safe to trade, but still she kind of moved up more into that high, as in where ES was better because she didn't take that high, so she confirmed even more. SMT for one is going to confirm that something is about to change, something is about to shift. Okay, that's why we use it for a confluence. We don't use it alone. Okay, it is a confluence saying that there is about to be a change. Something is about to shift in the markets. Okay, so just wanted to go ahead and cover that before we move forward with this trade, right? So we have our SMT. We're currently on the 5-minute chart again, right? When we're looking at price and we're determining our bias, 9:30 market opened up and we kind of just put in that accumulation. We manipulated NQ, took out this high, so now we're looking for our overall direction. This is kind of where we can start dropping down on our 1 minute and our 3 minute, and we can just really see our change in direction. Okay, at this point we get a change in state of delivery here, right? This is a 3-minute change in state of delivery. We also have a 5-minute change in state of delivery. Right, so we go ahead and place our standard deviation projection here. Right, this will be this first, right, basically our first distribution leg, but it is the manipulation of this high, right? And as you can see, if we look to the left, -4 standard deviation, -3.5 standard deviation aligns with the left. Okay, we always want our projections to be in alignment with our previous highs and lows. Okay, so this is kind of where we can drop down on our 1 minute. We can get an entry, say we decide to enter here. Okay, stop loss at the SMT high, right? And then what are we targeting? -4 standard deviation, or even before that, TP1 can be midnight price, right? Watch how this trade plays out. We kind of bounce and accumulate, reaccumulate, move a little bit higher, take a jab back above. So if you can look nicely, if you can see nicely here, right, we get a nice break and retest of midnight price. So we break it here with these lows, come back up and retest, and then we finally get another break. Okay, so break, retest, and we finish off the projection for the -4. Okay, right, that is the market maker model for you. Okay, buy side, sell side. Okay, all right, so this is the last example of this video. Okay, and then we're gonna go ahead and wrap it up because I really didn't want to make it too long, but the reason why I use this example for the last video is because there's a lot of context. Okay, and it is a lot of using past power of threes, okay, to determine our entries, and not only just before that, just before our entries, just determining where we think price is likely to draw to. Okay, so first and foremost, paying attention to this first projection leg that we have here. Okay, this high that was put in here, right, is a special high. Okay, that high there was predicted from a past standard deviation of predicting that this was the high of day. So obviously -4 from the past standard deviation, or being even close to it, okay, was kind of where we were projecting the high of the range, okay, and the high of range came up shortly of the -3.5. Okay, so not only did we put this high of day in for Monday, okay, which would be previous day high for Tuesday, SMT was put in, okay. NQ failed to take that high where ES did, okay, take that high. And this is where we got our projection to the downside, kind of depicting low of day for Tuesday. Okay, so kind of moving a little bit forward here, right? With us coming down, right, to the -2 standard deviation, right, also known as our reaccumulation, right? Remember that -2 and -2.5 is reaccumulation. Can't stress that enough. Not all the time, again, like I've said before, do we just reaccumulate and we finish out that move to -4 standard deviation. Okay, we don't always have to finish out the whole projection. That does not mean that price won't come back and finish it. It doesn't matter what we go and do, okay, or what type of trend we finish off of before finishing this whole projection, right? So just notice again how we come into -2, -2.5, and this is kind of where we put low of day in, okay? This literally is low of day. This became low of day here, right? At that point, we used this standard deviation based off the last previous projection, okay? So at this projection here, we put in low of day. Now notice there is no SMT, right? At this point, there is no SMT, but we do have a first distribution leg, higher probability because it is on the external range of everything that has happened so far. Okay, we came down, built sell side liquidity, and now we move into buy side liquidity, right? So this is the first distribution leg, right? We anchor it from this low to this first high of this distribution leg. Okay, it's even clear where you can see accumulation, manipulation of these lows, and then that distribution clear AMD. This projection here leads us back to all-time highs, right? And this projection, again, it aligns with previous highs and lows. So it aligns with what we had previously, okay, before even getting to this point, right? Right. So now this projection kind of brings us into Tuesday market open, open back up at 6 o'clock. And basically, we're using this projection to bring us back higher, okay, right? So we see price comes into, not only that, this 15-minute gap right here is something that was a very, very important zone, because I want you to see how heavy buyers stepped in at this point. Okay, we moved a little bit past the -1 standard deviation. Oops, we moved a little bit past the -1 standard deviation here, and we continue to uphold and support this 15-minute fair value gap. Okay, one thing that standard deviation always pays attention to is opening prices, whether that is the weekly open, whether that is the daily open, the 4-hour open. All of that is the power of 3, what we're projecting. Okay, so I am paying attention to true day open, right? 8 o'clock p.m. right? A lot of people don't call it true day open. I really call that true day open, 8 o'clock. So 8 o'clock, right? We really don't put any type of manipulation in on this hourly 8 o'clock candle, right? Market just kind of opens up and we expand. We come back and retest it, right? And then we just expand higher, okay? By that time, around 4 in the morning, we pull up to -2.5, okay? And this is kind of what we're looking at Wednesday. We want to project the low of day using this past standard deviation of, again, just like here in the past, we got to -2, we reversed, right? We had a projection there making low of day, okay? We use low of day projection, right, to predict high of day, or not even just high of day, just to kind of take us back to all-time highs that's already aligning with these previous highs and lows, right? We come to -2, -2.5, and this is where we come into today. Okay, what are we wanting to see for today? This is currently today. I'm recording what happened today, so we kind of tried to kick off this last kind of example with very current price action. Okay, so this is the first distribution leg of this move. As you can see, we have a double top, right? Already indicating that a shift may be happening. Okay, so this is the first distribution leg that we're using here, right? Notice how this whole projection, right, -3.5 and -4 aligns, right, with this 1 hour open. We never manipulated below it, right? So we want to see price come back and grab the liquidity, right, and manipulate lower, right? What do we do with this projection? We come to -2, we pull back up at the weekly open. All right, so we do a nice break, nice retest of the weekly open to finish off this move. And then not only that, what do? We catch a reversal. Not only do we catch a reversal, we catch a SMT at these lows. Okay, NQ failed to take this low, where ES took this low. Okay, so it's the 8 o'clock. It was that 8 o'clock candle, right? ES made its low of day here, where this is really NQ, where low of day is a little bit further. But all in all, I just want to spot out the SMT, which showed us that, again, first and foremost, something is about to change in the market. Okay, and so with this SMT, I want you to notice how we are below every drawn liquidity that we want to reach. We're below the daily open. Okay, not only that, before that, we're below that 8 o'clock hourly open. We're below daily open. We're below weekly open before any of this happens. Okay, with this SMT. Now, if we're looking at the projection on ES, okay, ES kind of capped her range with this whole move up to the upside at -2.5. Okay, there was no need to come lower. We needed ES to really make her low of day here. Okay, there was no need to really for her to come lower. All right, so we reject off this 15-minute fair value gap. We always talk about on drawn liquidity. So we have the whole anatomy of the IFM. We have our bias, right? We have our drawn liquidity. We have our SMT. We have our displacement. If you look here, right, we finally get our 5-minute CISD, okay? A change in state of delivery. We come back and retest this gap. We have our displacement, and then we have our draw on liquidity, our target, which is us moving back up to finish off this projection. So it's always that saying where, if for instance, if we're looking for the 4-hour power of 3, if that 4-hour candle does not finish that power of 3, it is likely for that next 4-hour to finish out. And what are we doing currently? Market is about to come up on the close, but it is nice seeing how we market pull back, right, at her known projected range to pull back. Not only that, did she just pull back? She pulled back into a higher time frame PDRA, which is this 15-minute gap. And then boom, rejected off that, and we got a reversal. Guys, that is all for this video. I've given a lot of data, a lot of context, and a lot of information for you guys to be able to go into the market and spot these type of things. This is the blueprint. Okay, this is the blueprint for the institutional flow model. I hope you guys enjoyed, and I'll catch y'all in another video.